Hello everyone and welcome to the True Potential Investments year-end special. I'm joined by Jeff Casson, our Chief Investment Officer, George Bell, looking very smart, investment analyst and suit specialist, and Matthew Henderson, one of our portfolio managers. Morning, gents.
Morning, Mark.
Today we're going to have a look back at 2021, but it started quite interestingly. You know, today we've had the lateral flow, we've then had the shave, shower and the shoe shine, but we're now going to get into what's actually happened in 2021. It's been a year of change. We've seen a lot of things happening and we'll see a lot happening in the future as well. Yeah. So Jeff, if I begin with you on the review of the year. We'll start with politics, and please everybody don't switch off now because this might turn out to be quite interesting, but there has been a year of political change.
It certainly has, and I suppose that's the thing you kind of forget in a 12-month period, the magnitude of the change that we've had to deal with, in the sense of a new president arriving in the US at the beginning of the year, which we thought was going to herald a lot of change. Interestingly, I suppose, as he becomes slightly more hamstrung in later months, but also I suppose right from the start, where he had a very slim majority to be able to do anything. So that's been, I suppose, from our perspective, something to observe and think about. We tend not to I suppose, focus too much on the politics, but it's become more of a challenge this year, particularly for Biden in the US. And then we've also seen, I know we can touch on the UK, but probably best to avoid really the challenges that we've seen here from a political perspective. But yeah, they've been evident for us all to see, and we have Lord Frost resigning at the weekend as well. So more challenges likely to come as we continue to navigate our way through that exit from Europe as well. I suppose maybe the one that's sort of slipped its way through without really much shouting about is Germany, where Angela Merkel has moved aside after 14 or 16 years in that role, and the new Olaf Scholz has stepped in, and it's been relatively straightforward. So hopefully that can continue. Maybe over to Asia, China, changing policy there. No change in the leader. Kind of wants to make himself the next Mao, one would think, with the changes that he's brought through, but looking to stay for the longer term, and also making quite significant changes for a number of companies, a number of sectors that we've seen influenced by that through the course of the year, be it property, which we've talked a lot about in morning markets. Evergrande has become a word that everybody is very familiar with, but 6 months ago we probably weren't. And also for the technology companies. So I think we've seen political change impacting regulation, but regulation impacting markets and impacting asset prices, and something that we have to navigate our way through. I suppose the one that maybe is not front and centre of anybody's mind is Turkey, where we have a leader there that seems to want to move away from all forms of orthodoxy when it comes to interest rates and inflation, and probably one of the most volatile currencies that we've seen this year, yet alone over the past week.
Yeah, and talking about Turkey, is that a Christmas reference? We've just got in there early.
Managed
Jeff.
to get that in early.
Yeah, there's some words we've got to get through before the end of this podcast, which are all festive related. So Jeff's chalked off Turkey very early.
Yeah.
George, you look at the True Potential portfolios, you look at them every day, positioning them for the future. What have you seen changing in 2021?
I think coming into 2021, we'd had the vaccinations in November. We didn't know that the 9th of November was going to be the day that all the vaccinations started to get approved, but we knew we were getting towards that point. So we were positioning the portfolios to the back end of last year towards the more economically sensitive parts of the market. So when we came into 2021, the markets were performing very well on the back of those areas which were unlocking from tighter activity restrictions. So the portfolios were strong beneficiaries of that exposure to that part of the market. As we've moved through the year, the discussion which has came back on the table, because you've got demand which has been so strong relative to supply, and we've talked a lot about the supply chain challenges which have been faced in the market, has been inflation. So within the portfolios, the changes we were making through the year were in response to high inflation prints. We were moderating our exposure to the areas of the market which were more sensitive to that change. We were looking at companies which were holding stronger pricing power, so the ability to pass on those higher costs to consumer. So essentially what we've seen is a very strong performance in markets, very strong performance in terms of equity markets, and we can get on to the returns of the portfolios in the session. But the changes which we've seen were that real sort of euphoria as economy started to unlock, which we rode that wave very well, and then managing the inflation discussions towards the back end of the year.
Yeah, okay. And Matt, in Growth Aligned, the fund that you manage with the team here, you know, what have you been finding? What have you been changing in 2021?
Yeah, I think it's quite similar to some of the points George has made there with the true potential portfolios. I think what we've been really focusing on is that pickup in growth, as George sort of mentioned, as economies were able to unlock, and then also towards the latter part of the year when sort of the inflation dynamics start to change a little bit more, start to focus a little bit more on that. So just a couple of examples of what we've been looking to do. In emerging markets, we added a new manager in there who was Artemis, the more value orientated. So as George is talking about there, it's getting into those more economically sensitive areas of the market. So we're talking about commodity producers, energy, financials, industrials, those type of names, and that's really benefited. But also, to the point Jeff was making previously there, it pushed them a little bit away from those areas that had become impacted by the regulation that came or the regulation change that we've seen come through in China. So really being a beneficiary of that. And then, as I mentioned, on the inflationary side, we've been looking to sort of protect from that uptick in inflation, as George said, from the demand side that we've seen. So really look to do that in two ways. One, a more traditional area that people might be more familiar with is linkers or inflation-linked bonds, so putting allocation into there. And then the other side of the equation that we've been looking at is trend strategies. So we're looking to take advantage of movements in market pricing. So some of our strategies can go long commodities, which are traditionally a hedge there, but they can also go short.
Sure.
So as inflation's picking up and the bond market's been coming off, those strategies have gone short in the bond market, and we've taken advantage of that.
Okay, and when you think about it, you know, we were talking about the political side of it to begin with, and you get political interference in markets, and you think, oh, please, just leave it alone. But probably sitting between the market and the politicians, you've got central banks. And we've seen a lot of central bank activity, particularly over the last fortnight. Jeff, you know, you're a keen watcher of what happens.
Yeah, and I think, you know, the communication's an interesting one. If you think back, 24 months ago, we were all fascinated by what Twitter was going to come from a certain president in the US. We've certainly moved away from that type of communication from President Biden and also, you know, a number of others. But the communication thing has really turned to central banks this year, and the language that they use, and you know, it's fascinating that we see it coming out on when the central banks put out their statements. You get this month, last month, and comparing down to the very words and the language that they've used. So that's certainly been something that's been a key focus for us and for our managers for the True Potential portfolios and Growth Aligned. As we've touched on there, it's all been about inflation, and we look back over the year how the language has really evolved. You know, we were talking about, and the central banks very much viewed it as being this word transitory was what we were going to have with inflation, but I think we probably all now agree that transitory seems to be an awful long period of time, and if anything, still getting slightly higher.
Yeah.
So we've started to see a number of central banks start to react to that change, which is required. You know, both Matt and George have alluded to the strength of the recovery that we've seen. We look at that from a GDP perspective, an employment perspective. It's probably not surprising that inflation has stayed relatively higher than expectations, but yet, as you say, started to see the major central banks take some action there. So UK, as we've discussed last week, albeit probably a bit of a surprise last week, we'd probably have thought they were going to do something on the 4th of November. But back to your original point, communication. Flag to the market, 4th, definitely going to do something, but failed to deliver, and brought about the volatility that Matt's been alluding to there, that, you know, trend strategies have been able to benefit from. That's what they like. So communication has been important. It's maybe moved from government into central banks, but still very nuanced, and I think that's the fascinating thing as we move into next year, where we'll see and have to think about how that language evolves, how
And-
their actions change.
Well, it's
So-
interesting. It's interesting at this stage seeing how there is divergence between central banks. If we look towards the US and the UK, which are back on their pathway of monetary tapering, so monetary tightening. Why? Because you're seeing those very strong growth numbers. You're seeing the strong employment numbers coming through, and they're looking at the inflation prints, which, as you say, are elevated, but the expectation is they will start to moderate. So they're working policy in a way which is adaptive to start to taper back, to start to build up that armoury, because economies are in a better position. If we look across to China, then they're actually back in easing mode. So they've been through that tapering cycle a little bit quicker, and they're back in supportive. So when we're thinking about central bank policy as a team, we've got to be very focused or very nuanced in terms of the region which we're looking at, because each central bank at this stage has got slightly different tacts in slightly different places, but they've all got very similar objectives. And I think the key thing which we're seeing from central banks is the importance of communication, because if they get this wrong, we've seen the effects. But the states, the Fed, I think it's commendable the way in which they managed their last decision, but it's demonstrating that they are flexible, they are adaptive, they are not looking to knock growth off course, and they're looking to manage this in an agile way.
I think flexible and adaptive is quite an interesting way to describe it, because that's also what multi-asset investing gives you in that context, and what the True Potential portfolio solution is giving, because actually these divergent views or different ways of approaching inflation are creating different opportunities, not just impacting equity markets, it impacts sovereign bond markets, impacts credit markets, impacts currencies, and that's, I suppose, the beauty of what multi-asset, what Growth Align provides us with, what our managers provide us with, that opportunity to go and seek out opportunity wherever it be, and divergent policy is probably no bad thing in that regard.
Yeah, and if you think about the announcement going back from the Bank of England, the 8-1 vote with interest rates have gone up. Now, what does that mean to a saver? You've got £1,000. It's an extra £1.50 a year on your £1,000. So interest rates are still so small you'll need a microscope for a saver to be able to see it. But when we build onto the multi-asset formula that you've got there, and you've got in the funds, Matt, and George in the portfolios, the returns that you can get on an asset-backed investment are so much higher than a very, very small increase in interest rates, but it's that grabbed the headlines.
Yeah.
And I think there's been other headline-grabbing investments this year. Recording this last year, it would be all about cryptocurrency, and that kind of rears its head every once in a while. But I think the stock for me, the one which has taken over from crypto, is Tesla, and the way that the price either rockets. Good thing for Musk, the space exploration, or it'll fall again very, very quickly. Turning to you, George, on this one, and I know you might not have prepared to answer this question, but within the portfolios there will be some sort of exposure to Tesla and the other tech stocks. Do you get any questions from advisors or clients around this particular area of single stocks within the portfolios?
Yeah, absolutely, Mark. And last year was a great example of where tech was a key performer, because it was one of the industries which was able to stay online when industrials and manufacturing lines were restricted through activity restrictions imposed by government. So technology was in focus, and that's an area which we do invest in within the portfolios through our multi-asset investment managers. So examples there being Close Brothers, be it Goldman Sachs, are key beneficiaries of their stock-specific exposure within those names, Microsoft, Adobe, those names which have been able to stay online and to generate very strong earnings. So the way in which we access technology as the portfolios is through our multi-asset managers. Why is that a great approach? We believe is because they're specialists. They have specialists in terms of tech analysts. They have specialists on the ground. They know these companies. They sit down with the board of these companies. They review their earnings expectations. They look at their order books. They look at contract renewal. So they are the experts in order to give us that exposure to technology. So do we have it? Yes, we hold it on what we would call a passive basis, so through index-linked products, but also through managers who know the boards of these companies very well and are backing those companies with investment.
Yeah, sure.
I think that's the other aspect of what multi-asset brings and what our managers bring, because we don't just talk about one view.
No.
We've got multiple views within the portfolio. Matt was talking there about the Artemis Value Emerging Market Strategy, which has directed itself away from some of those technology areas, and you'd probably be forgiven for thinking that there's only one sector in the market and that it's technology, because I suppose it's easy for people to focus in on because the names are all familiar. But then when we look at what's been happening in below the hood within asset markets this year, we've seen good performances from the likes of the energy sector. We've all seen what's happened with the price of oil, price of natural gas. That's been a really strong performing sector, and indeed probably has outperformed tech, I think, if we look at it just at this point in time. And financials as well. There's always, I think that's the thing, there's always key areas of the market where we can look within multi-asset, where our managers are looking and can actually, I suppose, get down to that very nuanced bit. As Matt's discussed there, you can get value in emerging markets, but we can get European financials on an index basis. Yeah. We can get the energy sector in more nuanced exposures as well. And that's all been areas that we've been able to be exposed to through the course of the year that have delivered good performance for our end clients.
And that's a really good point, Jeff, because we think about the very strong performance which we've seen at headline level in terms of global equities. But actually, if you get under the bonnet, what you're seeing is dispersion in terms of sectors and those companies within those sectors. So in terms of what that means for a multi-asset manager, well, we're not just a passive multi-asset manager, we're an active multi-asset manager, which means we can actually get in and exploit those opportunities which are, whilst you're seeing the strong returns, you can also pick up those areas of the market which are perceived to be undervalued at this stage, so you can benefit from that dispersion by being active.
Yeah, sure.
We've also seen that dispersion at a sort of a regional level as well, because at one point the US was sort of the only game in town. But back to the point you've been making, Jeff, and just around policy on both the central bank side of thing, but also government side of things has opened up opportunities on that regional level.
And I think that comes through. We talk about the strength of the earnings recovery that we've seen, and it has been a phenomenal growth in earnings that we've seen companies deliver this year. We look at the US 50-odd%, Europe similar.
Yeah.
But then you wouldn't think. But then when you dig down into the sectoral mix, the UK's been the strongest earnings recovery that we've seen.
Yeah.
Some 80%. But again, the broad equity market maybe hasn't done as much as one would have thought. But within that, there's certainly areas that have done very well.
And is the feeling that the UK is still the unloved part of the developed markets?
I think, unfortunately, yes. That certainly is the perspective that we pick up when we're speaking to managers that can invest on a global basis. But then it's also quite nuanced as well, because we've got this split between what it is that drives the FTSE 100 versus what it is that's driving that broader FTSE 250. And I think probably over the past couple of months there's maybe been a slight nuance in how people have started to think about maybe the 250 as offering something slightly more attractive, which speaks to some of the points that we've been talking about, the strength in the UK economy that we see from a GDP perspective, we see from an employment perspective as well. So there's maybe pockets of opportunity there for some managers, but certainly the broader theme is one of it's still challenged. But the other side of that, I suppose, is that private equity businesses, they certainly see real opportunity in the UK, and we've benefited within the True Potential portfolio solution this year by that coming through with a number of the UK businesses that we've owned being bought by private equity firms for significant premiums, which would take you back to saying, well, somebody believes that UK assets are undervalued at this point in time.
Certainly Morrison's would benefit
very
from
much
that.
So.
And before we came into the studio today, we were just talking about the level of corporate activity that you're seeing globally.
Yeah.
It was
it's a
figure.
Fascinating number. I think global M&A all-time high, $40 trillion this year. It's there's a lot of capital
Yeah.
available, and that's something that we've also talked about. But it's being put to work, and it's finding productive assets in which to invest that. And certainly, it seems to be that M&A is one way of deploying that excess capital that,
Yeah.
that both listed companies have. So seeing M&A there, but also seeing it from external participants coming into the listed area as well.
Yeah, sure. And looking ahead now, because it's great to be able to do a review to talk about what's happened in the last 12 months, but the portfolios and the funds are all about positioning for the future. And I'll come to you first on this one, Matt. Within Growth Aligned, what are you looking at now? How will you be positioning it over the next, say, couple of weeks, couple of months?
Yeah, so just over the next couple of weeks, I think what we're shifting towards is a little bit of a preference back towards the US, just highlighting some of the points George has made previously just around those tech names. What we've been thinking about is just sort of the unknown out there. How severe is this new variant? What's that going to produce? What's that going to be? So we've been looking to just rotate a little bit more towards that US side of things, where if we do start to see lockdowns again, not that I'm saying that is going to happen, but we are in this period of no one knows.
If it does, it's your fault.
If it does, it's my fault. I'll take the blame. But if we start to see that on a wider scale, I know we've seen some places in Europe already take action, but if we start to see it come through more globally, I guess what we've done is shifted towards the US. We've come a little bit out of those places in Europe, a little bit away from those more sensitive areas that George was talking about. So Europe, Japan, a little bit of the UK. And shifted it towards the US. I guess on the other side of things as well, what we've been looking to do is allocate a little bit more to government bonds, just on the similar sort of idea, where they're typically more defensive assets. They offer us typically a negative correlation to equity markets. So if we see equities fall, government bonds should normally rally. So that's the type of moves that we've been making.
Okay. I think the other thing for us as well, Matt, as we were just talking about earlier, is just the nimbleness that we have to have at this point in time, because we've talked about markets behaving well and returns being good, but that's kind of masked what's been happening in terms of the volatility that we've seen on a weekly, maybe even an intraday basis in some things, and that's, I suppose, why active management is still really crucial within that multi-asset construct, and within Growth Aligned we've been able to take advantage of that at times as well. So I think volatility works both ways. It creates a problem, and I know our viewers don't like us when we have to talk about that, but it's the reality. But volatility creates opportunity as well, and when you're nimble, you can take advantage of that.
Well, we saw that just the other day, didn't you, with some of the trades that you put through into Growth Aligned. You managed to get a good uptick, and you had the selection right, but the timing was also right of those trades, and they made a good amount of money during the day between the time you bought the holding and closing bell.
Yeah.
That's it. Yeah.
Yeah. So we bought those European ETFs.
Yeah.
And so we were just looking. We were sat saying there's not much change. We haven't seen any data prints come out. We've not seen, any central banks, any government officials come out and say anything. So from our perspective, we couldn't see anything that had changed.
No.
So we got into the market, and market came back, and then the next day market was up. So I think that's going to be one of the things that is probably going to have to happen going forward. People are going to have to be a little bit sharper. But just in terms of where we're going as well, I think one of the important things for us will be just keeping an eye on that inflation data. And just back to the points you were making, Jeff, this period of transitory was initially imagined to be 3 to 4 months. So it's been basically throughout the whole year, and even looking at central banks' own forecasts, you're talking through to Q1, H1 of it peaking and then coming off in the second part of the year. So I think that's going to be one of the key turning points for when we start to think about changing and going back the opposite way. Do we get out of the US a little bit more and back towards these more economically sensitive areas? Because as George said, the demand's still there. So if the inflation piece comes off, that should stimulate even more demand.
Yeah, and every one of our clients expects us to make informed and impartial decisions, just like the way you've highlighted that there within the fund. Now, George, turning to the portfolios again, informed, impartial decisions in order to drive returns for clients. What are you positioning the portfolios for now?
Yeah, just to set the scene, I mean, into next year we are positive on risk assets, so we see opportunity there. The reasons why: you've got consumers and households and businesses with strong balance sheets. Demand is there. The vaccine is a key factor in helping us overcome obstacles in terms of activity restrictions. You've got corporate earnings, which are very strong, as you say there, Jeff. You've got earnings in the US, growth of around 50%, and the expectations are very strong moving forward. You've got stimulus, which is still in place. We've talked about tapering back stimulus, but we're doing that because you've got growth which is firm. You've got employment levels which are coming down towards target. So there's a number of tailwinds towards risk assets. In the near term, the key discussion point is the Omicron variant and what this means. So within the portfolios, the way in which we've been positioning in recent months is just to be moderating those exposures to the very economically sensitive areas of the market, looking at companies which have pricing power. They've got areas such as technology in there. We've been looking at managers within the US as an example there. So in the near term, we've been bringing that exposure in, but that sets the scene for our longer term expectation as well, which is bringing in managers who we believe will perform better in a rising yield environment. Why do we believe that? Because we've seen managers or central banks are on an interest rate hiking trajectory, and in that environment we want to bring exposure to the portfolio which offers diversification to, say, global bonds in general, should we see yields back up, because in general that would be negative to the price. The products which we've been using to our managers there include alternatives. Why alternatives? Because they are in place to offer a low or a negative correlation towards equity and even fixed income markets. So when you've got yields backing up, they can provide diversification for clients. So as we look into next year, we are positive on risk assets, but we are very aware of near-term challenges. We've got the right asset mix and the right manager mix in there to navigate us through those, but maintaining that risk exposure. Why? Because as Matt says, if we get these inflation challenges start to moderate, there is a potential that you'll see a strong pickup in those more economically sensitive parts of the market.
Yeah. And I suppose, sorry, go ahead.
I was going to say, just on the other bit on positioning as well, I guess the exposure that we've got to interest rates within the portfolio, we've generally been pulling that down and keeping that short. So if rates do move now, we're not badly positioned for that, but as you said, we're just further shifting towards that. And I guess maybe what you were going to come on to as well is the beauty of the solution is that given them all the managers are making their own decisions as we're moving through this time period, they'll actually be making their own shifts as well.
Yeah.
And that's why tools like Growth Aligned are so effective within the portfolios, because Matt's talked through examples of how they were agile within the equity market, how they were agile within the credit market, because the True Potential portfolios we are allocating to managers which we believe best fit with that medium term outlook. The benefit we've got is we've got specialist active managers which we're exposing to who are making these decisions on a day-to-day basis.
I think, Jeff, what we've learned over the years is you can research, you can have great ideas, and then you can sit on your hands. Ideas have to be implemented, and what we've just heard there is that the decisions are being made to change investments or to add to different areas. Yeah. So implementation.
Yeah, it's crucial.
Yeah.
And having the confidence in your views is also crucial.
Yeah.
And that's what we see within the solution. We see our managers taking action, and I suppose that's the other beauty of the solution that we operate, is that there's activity at two levels. There's that activity that Matt's describing within one of the funds that we use, but then there's the activity that George is selecting as well at the portfolio level. And for our clients, that's that double layer of management, if you will, and thinking about how one best exploits that opportunity for them. So definitely, it's something that we as a team are very focused on, thinking about and looking at all of the transactions that our managers make. How are they making them? When are they making them? What does it mean? Is it consistent with the view that they're talking about? If it's not, certainly raises a question for us to think about. Well, we'll go and speak to them But the beauty is we just speak to them there and then.
Yeah.
We don't
Yeah.
wait until
Yeah.
we get a fact sheet in 6 weeks' time and say, oh, that's changed a little bit, we best go and figure that out. We actually see all of this happening real time.
Sure.
And I think that's the real beauty of the solution that we've got, that we can see it, see how it's been implemented, and think about does it work from our perspective.
Yeah, and you know, what really matters are the numbers at the end. And we're speaking now on the 22nd of December. And George, I'm going to bring it to a close now. And I know that you've got the portfolio performance figures for year to date. Could you just run through those, please? And then we'll...
Yeah, absolutely. I was going to jump in because I think we're very proud of the delivered performance of the portfolio solution this year. So let's think back to that backdrop which Jeff's been through in terms of all the challenges on the political environment. But we take the balanced portfolio, and after taking out portfolio charges, we've delivered a return of around 8.5%. If we look at the aggressive model, that returns over 13%. So in 1 year, that's a fantastic return for investors. And if we think about this relative to, you know, annualized returns and so on, if we think about on an annualized basis since we launched, that's a 7% return on average since we launched our portfolios for balanced clients. It's nearly 10% for aggressive clients as well.
And we're taking the optimism forward into 2022. So, gentlemen, thank you for your time this morning. To everybody who's watching us, have a happy Christmas. Thank you for providing us with the money to manage. It's now over 20 billion on the True Potential platform, which is a great figure to go out of the year with, and we'll add to that in 2022. So happy Christmas, everybody, and we'll see you again in the new year. Thanks now. Bye-bye.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.